That is our market recap for today. I would like to move right into our next segment, which is to wrap the week. Fridays are my favorite day to do the show, I think, because wrapping the week is what's most important because it is intentionally stepping back from the noise of the market, stepping back from all the flickering ticks of the day-to-day activity, which is where we have to live a lot of the time, and really focusing on the big picture. So what I like to do is a couple things when we do the wrap the week. Number one, I like to spend time with the Mindful Investor chart list. This is a long-term sort of oriented chart list looking at all the key charts that I use as part of my regular weekly routine to really understand what's happening and make a sense of where things are at. And in the morning, as part of my morning coffee routine, I look at this as well. We're also going to look at the relative rotation graph, think about sector rotations. We're going to look at what ETFs, what sectors, what industries have moved on the scooter rankings. Before we get to any of that, though, I did want to look over at sentiment. So I have a list of sentiment indicators. We're going to go down to the AAII rating. So, you know, the AAII, it's a sentiment ranking. So it's basically looking at the bullish and bearish respondents. These are individual investors talking about what they think about stocks going forward. There's an interesting jump. This actually comes out on Thursday, so it came out yesterday. And the last 4 weeks, we'd sort of seen this pattern of less and less bulls, more and more bears. And as of last week's read, the number of bears and bulls were almost identical. It was just around 32%. So overall, it was pretty even on people being on both sides of it. This week has completely reversed that trend, and we've seen one more time an influx of bullishness. So we gained about 30% of the read here. So the number of bullish respondents went from 32% up to almost 42%. The number of bears reduced from around 32 to around 27. So certainly more, people leaning more on the offensive side, leaning more towards bullish. 4 out of 10 respondents saying the market's more bullish for the next 6 months. So a bit of a rotation there. That had been an interesting divergence of less and less bulls as the market went higher. That seems to has resolved to the upside, showing that there's more, plenty of bullishness from the retail investors. Let's look at the Mindful Investor chart list. And again, there's a reason why the first chart on this page is looking at a very long-term view of the S&P. This is looking at a 5-year weekly view with some long-term exponential moving averages, the PPO based on the 21 and 34-week exponential moving averages, and then the weekly PPO or the weekly MACD. All of these are sort of long and strong, up and to the right. The market is in a healthy position. A chart similar to this is the first chart I look at every morning, and if you're a long-term investor, I would encourage you to look at something like this first thing before you look at any of the other noise telling you about short-term fluctuations. Pay attention to the long-term trend, which remains positive. In terms of breadth, interesting this week to see all the cumulative advanced decline lines ramp higher. And you can see one of the things we've talked about is this disagreement with large and mega caps going up, but then mid caps, small caps not confirming. All of them have confirmed to the upside this week. So this move to new highs overall has resolved breadth in a more bullish direction. All of these are in the green by my read. Feels very constructive. Also look at the number of new highs. It's something we started to look at earlier in the week where we saw, and I know at the end of last week, potentially this increase in new lows on the New York Stock Exchange. Those have all eventually evaporated here this week, and we've seen more and more new highs as these lines have gone higher on both the New York Stock Exchange and the S&P 500. Interesting to see a pretty extended read on breadth in the form of the percent of stocks above the 200-day moving average. Again, this is in literally, pun intended, uncharted territory. This is the highest reading you've had in years and years. The only other times it's been this high, up above 85% from what I've seen, is back before this, earlier on in the secular bull market, 2011, 2012 sort of years when you had a nice run higher. So overall, fairly constructive there as well. Some other themes to look at. Semiconductors are often sort of a tell for the market. When semiconductors are outperforming, that tends to be a good thing for the overall market environment. You can see as the S&P 500 has been going higher, semiconductors have actually been lagging a little bit because other parts in tech, other parts of the industry, of the sector rotation have moved upwards more strongly than semiconductors. But overall, still in a consistent uptrend, higher highs and higher lows. Similar pullback to what we saw in November before it resolved higher. So overall confirming sort of a step on the gas type of environment. Interesting to note the momentum factor is improving. This is something that had been underperforming, which is kind of a strange juxtaposition. How can the market be going higher, but momentum names aren't working? And again, it's all about the calculation of the momentum factor, what stocks are included in here. But essentially, this is betting on stocks that have been in positive uptrends and assuming that that will continue. And you can see that that's actually reversed higher. So far year to date, even though that was a group that underperformed in September and October, this is coming out of the market pullback in last August. Year to date, this has actually recovered very nicely and suggesting that momentum is working just fine. This is the relative performance of small versus large. You can see this still remains very muted. So even though the breadth characteristics on small and mid caps have improved, on a relative basis, you're still not getting paid for going down the cap spectrum. It's still the largest mega cap names that are driving things. And with growth versus value, we looked at this earlier in the week, I want to say, but growth continues to outperform in a big way. So there'd been this period earlier last year where it felt like the growth trade was kind of over. You felt this rotation more toward value. But look at how that ratio has just come like gangbusters, going to new highs. This is the pure growth versus pure value ETFs as well, also resolving to the upside. So overall suggesting you remain more with growth over value. Last chart I want to show on here, and then I want to get to some of the movers and the scooter rankings. This is looking at the U.S. versus the rest of the world, and I am keenly looking for themes like this that I think will catch people off guards. And potential themes that could emerge would be outperformance by energy. I don't think anyone is really expecting that. The underperformance of the U.S. versus the rest of the world. My guest on Wednesday, I want to say, Katie Stockton, talked about, she showed this a different way. She was showing the relative performance of EM versus the S&P and EFA versus the S&P. This is sort of the inverse of that, showing the U.S. versus the rest of the world. But at some point, this ratio rolls lower. It has not happened. You continue to see a move more toward the U.S. So again, as an American-based investor, it still pays to stay close to home. Let's finish off by looking at some of the scooter rankings. So we're going to go here to the member dashboard. We're going to go to charts and tools. We're going to go to scooter reports. We just have a minute left. I feel like the wrap of the week could be an entire segment. So someday we'll figure that out. But let's look at the industries that have been on the move. Change. So the industries that were up the most this week in utilities, I want to say the water index, in healthcare, medical supplies. You can see some really interesting groups being represented. There's industrials, there are materials, gold miners, up 28 points in the scooter rankings. That's a big transition from being one of the weaker groups. Materials have been sort of a forget about it sort of sector, but you can see gold miners, mining index, all some of the biggest movers to the upside. Also a lot of home-related, home construction, home improvement, retail. Number ties have been up there as well as some real estate. On the downside, you have some of the financials. You have banks, you have fixed line telecoms, that's AT&T, Verizon, tobacco, broadline retailers. So there are a number of spots. What concerns me are some of these financial sector, banks, asset managers, all some of the worst performers this week using the scooter rankings. That's all the time we have for that one, but I'd encourage you to spend more time with the scooter reports. Look at the 1 week change, also on individual names. You'll find some stocks that have moved you that you might not be as aware of as you should. Folks, we're going to take a quick commercial break. We'll be back opening up the final bar mailbag. We'll see you in a minute.